Hello, everybody. It's June 1st. Time flies when we're having so much fun. It's 11 a.m. Here in Long Island, and we've had beautiful, beautiful weather for the past few days. A little bit on the chilly side for this time of year. You can't kind of go swimming or doing much water activities, but all in all, things have improved a lot. At least we're not getting rain. And June 1st, so summer is coming. My wife and I will be going over to Santorini and Crete next week. I'll probably pre-record a, uh, a session with so we can keep the dialogue going, but I won't be able to do any Q&A next week. Uh, this time around, we're doing this live here on Monday morning, and we can certainly do some discussing of things. Lots to discuss, of course. The our theme of FIMO, fabulous earnings momentum, continues to work because earnings continue to have upward momentum, and it's been absolutely fabulous. And the market definitely. I think I got that a little high there. And the market definitely is focusing on that. And the difference between FIMO and FOMO. FOMO is fear of missing out, and fear of missing out. That's primarily a valuation phenomenon. People will buy stocks as the valuation multiple goes up, and they kind of believe that it's a new era, and there's nothing that can go wrong, and so they kind of pile into the market even as the valuation multiple continues to get higher and higher. This time around, thanks to the FIMO, the earnings momentum, this has been an earnings-led melt-up, and it continues to be that. Of course, in terms of what could possibly go wrong, if something causes a recession, that would certainly question the whole FIMO ID. And on top of all that, it's not as though the valuation multiple is low. It's around 21 for the S&P 500. It's about 23, 24 for the technology area where we've had the most FIMO. But a recession certainly would clobber the FIMO thesis and would also bring the valuation multiple down. But in other words, we'd have a bear market. But bear markets is what you get when you have a recession because you get clobbered on both PE and E. This time around, the E looks remarkably sturdy, remarkably strong. It's certainly consistently beat expectations. A lot of that has been in the technology area, but where revenues have been very strong and where margins have been going higher. But we're also seeing some pretty solid margin improvement in other areas of the market. It's just that right now we continue to have a very concentrated market. We are going to write about SpaceX and the other IPOs probably in today's quick takes. And our initial feeling is that it is a lot of money, but if you take SpaceX and Anthropic, um, let's see, can just one of you tell me that you're hearing me okay? Because I got somebody on the Q&A saying, "Is it working?" I'm not quite sure. Oh, good, good. Okay, thank you. All right, so we're good. Um, so anyways, we'll be discussing SpaceX and Anthropic, of course, and OpenAI. And collectively, their market cap could vary once they actually trade in the public markets. The market cap could be somewhere between $4 and $5 trillion. So that would be extraordinary. But of course, that's not what's actually being raised. What's actually being raised, I would say, for the three of them, might be something more in the order of 250 to $300 billion. That's still a lot of money, and the question is whether what impact will that have? Where will the money come from? I got a call from my broker asking me if I'd be interested in participating in the SpaceX IPO. Elias got Toby, I should say, over in Melbourne, got called by his broker, and so I've never had my broker call me up to participate in any IPO before, and so it looks as though we are going to need retail investors to buy into this. And meanwhile, the exchanges have changed the rules to make it much easier for these three IPOs to trade publicly and to be included in the indexes, which means that index funds will be forced to buy these things. And we know from SpaceX the float is pretty small. So how can I put it delicately? Are these things being rigged for success? I mean, certainly looks that way. SEC doesn't seem to be particularly troubled about the exchanges changing their rules, but clearly Wall Street recognizes that the old way of raising money may not raise enough, and you have to bring in the individual, you have to force the indexes to come into this. Um, Look, I don't want to put a negative spin on it. I want to be kind of objective about it. But the flip side of it is it could bring in a lot of people into the market that might not have been in the market before. SpaceX is a very exciting concept, and here individual investors are being given the offer to participate in the IPO. Why not? We all know these stocks are going to go up. Question is whether that'll be met by a deluge of selling by retail. So it's going to be interesting. And by the way, SpaceX is scheduled for June 12th. June 17th, just a few days later, the FOMC is going to put out its statement for its latest meeting. And Elias and I still think that the Fed is going to drop its easing bias, which is what seemed to come across at the April statement and the April press conference that Powell held. However, a couple of weeks ago, when the FOMC minutes actually came out, they sounded pretty hawkish. They didn't sound anything like there was an easing bias. Actually, there was some discussion. I wouldn't know if it was heated or not, but there was some discussion. Some thought that the easing bias should be dropped completely. And by the way, we know that's the case because there were three dissenters who basically took that position. But what we didn't know is that some of the other members and participants, members or voters, participants are all 19 people that are in the FOMC. But apparently there were quite a few others that wanted to drop the easing bias. So I think it's pretty clear that the easing bias will be dropped at the June in the June statement. I presume that we're going to have a press conference from Kevin Warsh. He said that he may not be as communicative as Powell was, but I can't imagine that he's not going to have a press conference kind of laying out his view of things. But that should be kind of interesting because I think, again, they're going to drop the easing bias. Now, the question is, do they go to a neutral bias or do they go to a tightening bias? And given the April FOMC minutes, which again I interpret as being actually hawkish, notwithstanding the way they were sold by Powell, I think they could jump straight to a tightening bias. Much, of course, will depend on their perceptions of the extent that the oil shock is transitory or turns out to be more persistent. Today, it certainly seems to be more persistent. The oil prices are up about 6-7%. The Iranians said they don't really want to exchange notes with the United States in their negotiations with the United States about extending the ceasefire. I don't think this has actually been a negotiation to end the war. It's been just extending the ceasefire. But the Iranians insist that the ceasefire includes Israel going into Lebanon. The only problem is Hezbollah has been launching drones into the north of Israel. So you can kind of understand why the Israeli army, has been persistent in Lebanon. So it's hard to imagine how that sudden requirement by the Iranians gets met. And meanwhile, the Iranians are threatening to shut the Strait of Hormuz. And oh, by the way, there was news over the weekend that the president of Iran resigned. Uh, and the reason he resigned, apparently, according to the news story, I think it was Reuters, but I'm not sure. According to the story, the reason that the president of Iran resigned is because he feels like he's powerless and that the Revolutionary Guard are basically calling all the shots. So what's the point of being president if you got absolutely no power? And certainly, this move by the Iranians will be consistent with the Revolutionary Guard's approach to this situation than it would be with maybe more moderate factions within the government. Well, anyways, the price of oil is up, and if it remains up and there's no resolution of this situation by the FOMC times, and they'll have to conclude that the price of oil could remain up, and then of course Exxon and Exxon and Chevron have been both warning that the inventories are running bone dry around the world, and that could lead to a spike in oil prices up to $150. So a lot can happen here in the next few weeks that'll convince the Fed that they've got not just an energy problem, but an energy problem that has the potential to spread into a broader list of prices. So we'll see. And before the FOMC meeting, there will be actually a CPI and a PPI, and there'll be an employment report. And labor market's kind of been going our way. It's we've been saying that it could surprise people to the upside, and all the major labor market indicators suggest that'll continue to be the case in May. March and April was stronger than expected. So the argument about the dual mandate, where the risks are, I think the risks are diminished on the employment side, and the risks are increased on the inflation side. Hence, I conclude that Elias and I conclude that the Fed could very well issue a tightening bias at the June meeting. And then the question is, do they just kind of sit on it into the July meeting, or do they act on it? And again, it's once again probably going to be data dependent, but I think in terms of their credibility and the fact that they're still wounded by their lack of credibility in responding fast enough to the inflation of 2021, early 2022, they might very well do a quarter point. So June could be kind of interesting. We got to watch oil prices, we got to watch the FOMC, and then we've got the SpaceX IPO. I'm inclined to think things could get a little choppy here. I'm inclined to think that maybe we've kind of stuck with our energy overweight and kind of thinking about that's not a bad place to be, kind of on a hedging basis for the geopolitical issues that we're facing right now. Still, though, hanging on to 8,250 S&P 500 by year end. Just trying to be realistic about what the risks are and what the near-term problems might be. But let's go share some charts. And these days, I like to start with the quick takes. We're talking about in the U.S. market call. As you may have noticed, we're not doing a U.S. market call and a global market call. If nothing else, trying to keep us make sure that we're keeping posted on developments overseas. Been a little lax on that over time, but given that we think go global might work, which it hasn't of late, but go global should work if the price of oil ever comes down again, which it should. But right now, the U.S. certainly looks like it's got more going for it than the rest of the world. And of course, the rest of the world has turned out to be mostly South Korea and Taiwan, which is the point we made in the latest global market call. So let's look at the market. We've had this concentrated rally here huge rally in the S&P 500, a wee bit extended relative to the 200-day moving average, less so when you look at the market cap, the equal weighted S&P 500, but that also has managed to make a new record high. Um, for those concerned about breadth, the small caps have done pretty well, but there again, a lot of it's been actually in the technology area. But the index is up, so if you own the index, you're still making money, no matter what's actually driving it. And meanwhile, here's FIMO. Without any further ado, this is forward earnings for the S&P 500. Just keeps going out to the new record highs. It's going to converge by year end to whatever analysts think 2027 is going to be. And right now, they keep raising their 2027 numbers. And so this thing is going to keep going up until this is a time weighted average. So we're giving more and more weight to 2027. So that looks very strong. Then we've got a good part of that strength, of course, is information technology. And here's the 2027 estimates of analysts for information technology. 2026, both are going up. So time weighted average of two variables that are going into to make a new highs here obviously leads to new highs at a more rapid pace for forward earnings. When we go back to the S&P 500 earnings story based on what analysts are looking at, and again, we've previously pointed out to you that analysts actually are worth following when the economy is not heading into a recession. They don't tell you about recessions coming. That's kind of up to you and me to get that right. But if we both agree that there's not going to be a recession anytime soon, then I think we need to treat analysts' consensus expectations as very useful information in terms of where earnings are going and the rate of change at which they're going there. And right now, the rate of change looks phenomenal. 19% is the way we're basically ending up the Q1 earnings season. I mean, just kind of straight up here. And a lot of that had to do with the AI companies that reported a lot of strength, the semiconductor companies. What's interesting is all the way to the fourth quarter, they're increasing their growth rates, double digits across the board. So um, is this irrational exuberance? I don't think so. I think the analysts are responding to what the companies are reporting, and the companies are reporting that their earnings are much better than analysts had expected, especially in the first quarter. And so it's been up, and away. Uh, Again, with regards to breadth, we are seeing some breadth with regards to small caps, but we're also the explanation for that is we're seeing an increase in breadth when we look at forward earnings. So this is going straight up. I have to admit to you, I'm exaggerating a little bit because I should put in ratio scale. We do have ratio scale. Doesn't look quite this dramatic, but the certainly bring nails the idea of FIMO. But we are seeing the mid caps and the small cap earnings. They were kind of in a coma here, uh, and here they're taking off into record highs. Breadth measured as percent of earnings breadth, percent of S&P 500 companies with positive 12-month percent changes in forward earnings and forward revenues. You can see that's looking pretty cyclical. I mean, during bear markets, these things obviously turn down as analysts can recognize that things have turned out to be much worse as they get feedback from companies that things are not going well. But meanwhile, this is another example of FIMO, the surge in earnings. We saw this surge in earnings in technology in this chart, right? So here's the forward earnings, and it's forward earnings times forward PE. And so here you can see the forward earnings have been so strong that the forward PE of the tech sector is actually not much higher than it is for the overall market, as you can see by these two numbers, and that's wildly different than what we had here, where the forward PE was was a 40 for the technology sector, and high but much lower for the rest of the market. Meanwhile, sentiment is kind of neither here nor there. It's not too many bulls, not too many bears. So that suggests that there's more upside from a sentiment perspective in this bull run here. If this, if we saw the bull-bear ratios at previous highs, that would be suggesting that we may be due for some sort of pullback. Um, then again, looking at percent changes of the various indexes relative to their 200-day moving averages, I mean, the market is a bit extended here at 11% for the S&P 500 above its 200-day. And then the areas where it's most extended is technology, materials, energy, services, some industrials. Uh, the bond market, remember back here, there were a lot of headlines saying the bond market's crashing. We weren't particularly concerned because we kind of view 4 to 5%, really 4.25 to 4.75% is kind of the range bound bond market that is consistent with normal. Normal is what we had with these kind of range back before the great financial crisis. So we think this is just indicative of kind of a normal economy. Bond yields should be around these levels as an indication that the economy is doing well all by itself. As I said that, I realized that that's not quite correct. We are running $200 billion deficits. Let's not forget that as one of the reasons that the economy has, in fact, been quite resilient. Commodity prices between the Strait of Hormuz shutdown and between the AI trade, we've seen a lot of commodity prices up significantly. Copper is at the top of its channel here. Let's see, this will be kind of an interesting point to see whether it breaks through to the upside there. Gold is down today. Looks like it's got some support at the 200-day and at this intermediate trend line, but it's showtime here. So I guess if the war gets heated up again, gold's going to go down, and that'll be a different technical picture than going up. So we'll keep you posted on that. With that, oh, I should let me see. Okay, let's go now. Well, we don't have to go anywhere. Let's do. I was going to take you to the charts on the Fed, but you can see them yourselves in the morning briefing. And the basic message is inflation is heating up. No surprise there. Maybe a surprise that the labor market's firming up as well as it has been. And the conclusion is. Rate cuts are definitely off the table. A tightening bias is very likely at the June meeting coming up, and then a likely rate hike. That's our outlier view because I think right now the markets aren't expecting that. So let's take some Q&A here. Okay, I've got only two right now, so let me know if more of you. Oh yeah, no, they're coming in now, fast and furious. Um, Willem, you got a long one here. Let me see if I can read it real quick. The counterpart of FIMO is a significant reduction in the share of labor income in GDP, now at its lowest level, 53.8% since data started to be collected. That's correct. The labor share in national income is down. In 1970, it was 65% of GDP. I recognize that the share of labor income is understated by treating all of the income earned by one person's firms as profits. Yeah, I've made that point before. Proprietary income. I mean, I'm working for a living. I should be included in labor share of GDP, and yet I'm included in proprietor's income. So that was going to be my response, but you got that. There is, however, no evidence that the share of one-person firms' income GDP has increased significantly. Oh, by the way, you might want to also include rental income. Landlords work for a living. I mean, they have to maintain the properties. So it's really rental income and proprietor's income. We'll update that we have that data on the website, and we'll update that in one of our morning briefings up ahead here, maybe quick takes. Um, Even though the average real wages continue to rise, labor share is steadily declining. Is this a political and economic problem? Do we have any solutions if it is a problem? Willem, all good points. The one thing that you're not mentioning is the points we've been making for a while here is the demographic effect of baby boomers retiring. Um, as I'm not retiring, and I'm making a comfortable living thanks to you folks, but there's a lot of my friends who've been doing very well, and they're giving up some pretty substantial pay packages by retiring. But I think a lot of them between COVID and just getting older. My cousin, I told you, has been going more often on cruises, and he told me the other day they want to do it while they can. I mean, as you get older, you start to think about at what point might you be infirm. So, try to retire and enjoy life, travel, go out to restaurants, um, movies, shows, and so on. And so I think there's a lot of that going on. And what you're not mentioning is the $89 trillion of net worth of the baby boomers. And then I don't have any hard evidence, but there's survey evidence that's saying that 30% of young adult children, unmarried children, are living at home, and something like 80% of young adult children are getting financial assistance from their parents. So there's a lot of that going on here. So I don't, I mean, the charts you're looking at are, consistent with the way the economy used to be, and I'm arguing that it's changed rather dramatically. Lee, just prior to the attack on Iran, the 10-year T-bill was trading quite strong with a low yield. Since then, inflation and concern about bond market reaction has been a concern. Oh, look who's there. I didn't know that. Uh, Should have told me Max was here. If we see that most of this concern is circumscribed by the Iranian conflict, how exactly does the Fed's adjustment of the overnight lending rate help resolve inflation and bond market sell-offs? It doesn't. I mean, a quarter point increase in July isn't going to change things. However, I think the Fed, if the market keeps behaving the way it's behaving and SpaceX just goes to the moon, I think the Fed has to be concerned about the potential of them being not restrictive enough when it comes to financial stability and speculative excesses. So that might come into play. Um, I think there's still, the majority of just about everybody at the Fed thinks the Fed matters. What you're saying is something I kind of agree with, is maybe the Fed doesn't matter as much as they think they matter. I mean, I love the Fed. It's a content provider for me. It allows us to write about what the Fed's thinking and doing. It's not clear with the benefit of hindsight if the Fed acted 3 months or 6 months earlier in raising interest rates back in 2021, 2022, that it would have made any difference whatsoever, given that a lot of it was pandemic related. So it's a good question, but I think they think they matter, and I think they were still kind of sore. They still feel bad about having been viewed as being kind of tardy in tightening last time, and they're talking more hawkish to a lot of them. There'll be more talk this week, so we'll keep you apprised of that. Uh, okay, your comments about the Middle East data centers were interesting. Did this imply that U.S.-based assets should receive a premium? I don't recall mentioning data centers during our call today, but if you think I said that and you think that's smart to bring up, great. But I guess yeah, I mean, it's a good point. Data centers in the Middle East look somewhat vulnerable. So do the telecom cables under the Strait running in the Persian Gulf look vulnerable. So yeah, sure, the U.S. Looks. I mean, the as long as the war isn't over, go global is not going to perform very well relative to stay home. Um, okay, Brian. Hi, Ed. Are you sticking with EMXC for international exposure for now? The large percent to Taiwan is a little worrisome. Thanks in advance. Yeah, for now, but we have written recently that, yeah, we get it. It's largely a Taiwan and South Korea play, and it's not fundamentally an emerging markets play, which the idea is emerging markets are emerging. They've got bigger middle classes. They want to prosper, and so on and so forth. Emerging markets are not going to enjoy seeing the Fed move towards a tightening bias, and they certainly aren't going to appreciate a Fed rate hike. Yeah, I think I kind of uh, got the point across when I said, until the war is over, stay home is going to outperform for a while longer. Um, With the Fed failing to shift to a hiking bias in June, change your view that we get a hike in July. I think they would want to more incrementally to move more incrementally towards hiking, if that's their plan, which would include starting to discuss the possibility of a hike in various speeches. Yeah, I mean, it's a good point. I mean, we are definitely outliers on that. I know some people find it a little odd that we're bullish on the stock market going to 8,250, and yet arguing that the Fed might actually tighten. We think the market can handle it. It could present another one of these buying opportunities because people will say, what difference does a quarter or 50 basis points make? And the economy will continue to show its resilience. I mean, so far, this has really been an amazing economy. Resilient is the word we've used over and over again. We've continued to point out it's passed many stress tests, and that continues to be the case. If you got a couple more minutes, I got a couple more minutes to answer a few more questions here. Matthew, good morning, Dr. Ed. Any thoughts on current S&P 500 PEG ratio under one due to significant earnings growth compared to prior low PEG levels due to price declines stemming from economic difficulty? Yeah, that's a good question. The long-term earnings growth expectations, LTEG, have just gone straight up. The highest ever, if you take out the kind of aberrational pandemic area. I think long-term earnings growth expectations by analysts on a consensus basis is up to like 22% per year over the next 3 to 5 years for S&P 500 earnings growth. There's no way that's gonna happen. They always tend to be too optimistic. A more realistic number in the past for them has been 10 to 15%, which is on the high side of what reality has usually delivered. Um, but so there is a potential, clearly, for FIMO to blow up if we have a recession. Then suddenly all these analyst expectations for 22% long-term growth will come down pretty rapidly. But that's what recessions do. Uh, Lee, with regard to SpaceX offers, I remember The Godfather. Why do I deserve such generosity? It's a good question. Thanks, Lee. JR, foaming the runway, so to speak. Okay. Uh, uh, View on gold, silver. Um, I've warned you before that I'm no gold silver expert, certainly not silver, and certainly not gold. Just been looking at more technically, and what seems to be driving gold is for the while there was central bank buying, but the war has caused some central banks to have to scramble to support their currency, and they've been doing it by selling dollars reserves and gold reserves. But I think we're sort of like at an important point here. I would say near term here, I don't know. Longer term, the basic idea I've had is rebalancing. That if we get to 10,000 on the S&P 500 by the end of the decade, and I've given you, uh, I think, a fairly solid explanation of how that could happen, then rebalancing could very well. Yeah, people get nervous as the market goes higher and higher, and they worry more and more, and they rebalance, and they'll rebalance into bonds, and they'll rebalance into gold. How much margin buying is there currently? It's at a record high margin buying. The margin buying only tells you that the bear market could be more severe if you're at a record high, if something causes a bear market. It doesn't usually cause a bear market. Anyways, a lot of moving parts here. A little caution advised on my part here in the short term in June. But have a good week, and I'll see you. I'll probably record a session for next week. Thanks very much.